Hi, this is Randy Finney with the Right Side of the Chart, and today is Friday, May 27th, 2016. I'm starting this video just after 2 o'clock Eastern Time, shortly after Yellen's announcements. Janet Yellen made some hawkish comments today, so we're seeing a little bit of from the highs, a little bit of a sell-off in equities. Nothing major. Gold coming back in and GDX back towards their lows earlier. So really, it's Friday before a 3-day weekend, at least here in the U.S. We have a 3-day weekend coming up. So I wouldn't be doing much. I tend not to position really ahead of a weekend. As a swing trader, you assume 2 extra days of overnight risk. So if nothing else, the only thing I've done today is lightened a little bit up on my GDX short today for the first time, booking some profits. Actually, I did that just now, right before the video started here. And I'll go over those reasons I made mention in the trading room. So we'll start out just a review of gold and the mining stocks, and I'll touch on the markets and maybe oil, and then we'll wrap it up there. Try to keep this one quick. All right, this is gold, daily chart. Gold has just played out beautiful as far as, to the technicals. This is a clean bearish rising wedge pattern. It's been highlighted. We broke down. As I mentioned, every single day since breaking down, that's 1, 2, 3, 4, 5, 6, 7. This is the 8th day. We've closed it down every single day. We're currently trading down about 0.75%. Still a couple hours before the close, but that just shows you how well this played out. And this couldn't have been a more clear, like I refer to as a textbook, pattern, negative divergence, broke down right about where a pattern should break down, in proximity to the apex and that wedge. And so there we're at. We're at slightly below, but not enough to safely say that level's been taken out at below the resistance at 116 level, as you can see. So gold is at or near, even right now slightly below resistance, and of course my next downside target is down here around 114.20. I can play around with that line, probably move it up to that level, 114.62. I think I like that a little better. But I had I had that line here. There's a reaction back there. So call that, if you will, the next target zone, probably all the way down to the top of that gap there, and that would be, let's try to hit this for you and put the call it 113.50. Let's just call it that. All right, so about 114.60 down to 113.50. That would probably be a very objective area if you are short gold or the miners, if gold gets there and you're willing to ride out any bounces. Again, my point here is we're down now well over a week, down every day. Gold in that time period since the breakdown of the wedge has dropped, almost 5%. That's a considerable move of gold, wiping out, bunch of gains here. And so we're getting overstretched. You can see the RSI is coming up on that oversold level. We're not there yet, 32.71. So a little more downside on the daily time frame, but sooner or later we'll get a bounce here. But I want to make this clear. I don't have any intentions of reversing, at least for a swing trade position. I'm not going to do anything until at least next week. If the charts line up, I might try to play a counter trend trade. But I do think that I don't see a V bottom, a V reversal here, and a blast off to the top. If we get a counter trend bounce, and if you're looking at some levels, we have resistance here from about 118.70. I'm looking at the gap to the left here, down to about 118.25. A bounce might terminate there and come back down. But again, hard to say in the near term. But let's zoom in on some charts. One of the members, Pangblood, in the trading room pointed out the XAU USD, gold and US dollars, and the 60-minute chart. Here's a view of gold with divergence, but at this time it's only potential divergence. My book might be different from the textbooks. I don't know if this is written anywhere, but I always refer to confirmed and potential divergence. At this point, we almost had, we did turn up, and it looked like confirmed divergence, but it never played out there. So right here, you can see we still have potential divergence. However, I call it potential divergence because the MACD, the MACD is clearly pointing lower, as is the RSI. So what I want to see to confirm divergence, while gold is still making a lower low, I want to see the MACD make a bullish crossover. That means this blue line comes back above the white line, bullish crossover, and turns back up. And so if that happens before we take out this low, that would be confirmed, what I call confirmed divergence. And I didn't like the look of the MACD at this point in time, so I didn't do anything. But right now, like I said, just because the weekend's coming, I just lightened up. I think that's prudent. And again, it depends where you entered. I posted, long before the official short trade entry, I was short gold or the GDX right near the highs. So I've ridden that position down quite a bit, and all I'm doing is just reducing my exposure for the long weekend and holding holding on to some of that as a longer term short trade, and willing to ride out any counter trend bounces unless anything changes in the charts that convinces me that the move down, the correction is over. So there it is, a potential bullish falling wedge. Prices continue lower. Maybe that expands. Maybe we can move into I could see a formation of a descending price channel here. You see this price channel. That's another way to view this right now. And I could easily see gold coming down a little lower. And, if these divergences are burned through, that's going to be extremely bearish. And remember, the bigger picture, coming back here, when trading the short-term charts or looking at the short-term charts, keep the bigger picture in mind. This is a very large and powerful divergence that built from mid-February all the way through the top and around the beginning of this month. And there may be more downside. And even if there's not a lot more downside in price, there may be in time. In other words, we may come down here, grind around, have a few rallies, but not really go anywhere, and not blast off and take out these highs for months. That's quite possible. We'll just have to see how it comes. But as you can see, this move so far has been very impulsive. Just be careful trying to catch a bottom in gold, especially the miners. Can't say enough on that. Trade these things long enough and you realize how volatile they are, especially if you're trading dust and nuggets. Please account for that 3-time leverage, and then account for the fact that a 3% move, is just run of the mill for these gold mining stocks, especially the GDX, the ETF, and obviously some of the individual names move more than that. So these are my targets here. We've hit already 2 of those targets, and my final target on gold or GDX, I'm sorry, is 21.52, and I do think that gets hit over time. There's that bear flag that played out. So far it's playing out. There's the large rising wedge, negative divergence in GDX, and take a look at that on the 60-minute chart, and you can see these levels more clearly. Flag pattern breakdown. We came back, stopped right at that gap. You see that gap in there? We tried to fill that gap, turn back down. And so if I had to take my best guess, even though I've lightened up, I think we go down. That's why I left some on. I think next week we'll hit this, probably early next week, this 2140. 2140 is the actual level. I always set my buy to cover orders just above that. I don't want, if everybody's watching 2140, I'm not going to hold out for the last penny. I'm glad to cover in this case. I give it a pretty nice buffer of about 12 cents above that level. And at that point, I'll be out. And somebody asked me the other day, and again, as I just mentioned, I don't plan, at least at this point, I don't plan to reverse long. But if I see something in the charts by next week, I'll let you know. I'll study the short-term charts all the way down to the 15-minute charts, 15-minute time frame, and see if there's a reason to reverse that for a long trade. But even if gold and GDX continues lower, I could see a potential move on GDX all the way down here to 19 if things get really ugly. But again, it's about risk reward. I'm not going to hold out. We're coming up on a nice support shelf, and have a nice profit. I'd rather just book it there. One option, and I'll consider this, sometimes I'll do it, is instead of just booking full profits when that target's hit, sometimes I'll just put a tight stop. Let's say we're running down there. So maybe when we get to 2152, I put a stop at 2160, for example, and then just trail that stop down if we slice right on through that level, because that is a possibility. Sometimes when you had just a frenzy of buying and extreme bullish sentiment, sometimes when you finally have a breakdown like this, you get some real impulsive moves that can just shatter right through support. So will that happen? I don't know. Again, the only way to safely trade it If you're short, I would not be shorting here at this level. I want to make that clear. The risk reward rapidly diminishes, especially, we're quite a bit oversold in the very near term, but not on the daily chart. You can see there's room to go. We just crossed below the 50 level on the RSI. We're down to 43. So near term oversold, but we're not longer term, and that's why there may be some more downside in the miners ahead. Take a look at the dollar real quick. The dollar went into my analysis, going back for over a month now, I guess, calling for a pullback in the, a bounce in the U.S. dollar, and we've had quite a bounce. And this is a daily chart here of UUP. I started calling for that reversal in the dollar shortly before it happened. Pointed out, we'll look at this falling wedge on a shorter term time frame. So we went ahead and we broke out of that falling wedge or contracting channel pattern, moved up. We hit this as a target I had here, 21.75. We hit that last, I think, Tuesday. Yeah, there it is, Tuesday. And we had a nice reaction, 2 days where the dollar pulled back, and now it's powering back up above there. So I've always said a lot of this is in the charts. Some people don't believe in that. Some people will cite this move to, today's move to Yellen's comments. Maybe, maybe not. I don't doubt that plays into it, but I think that was priced into the charts, is what I'm saying. So we had that move up. You can see how well it works. We came up, we challenged the top of that channel, broke above it, gapped above it, moved up, hit resistance, and I had this line here for a while, pulled back, and off the initial tag of that resistance level, now we're powering up. So to see UUP cross above the high of 24.78, that would be bullish, and we're right there right now, 24.79. So let's see how we close the day and really trade into next week. I'll take a look at the charts of the euro and the yen. The euro is by far the largest component of the dollar index, and the yen's the second largest. I'll do that and share my thoughts in a static post or charts over the weekend as well. So that's UUP from a weekly point of view. I'd rather look at the dollar index. There's the long-term chart. There's that trading range we've been in, and I've highlighted for over a year now, well over a year. This was a fake out move that I talked about. See, we had a intra-week but failed to close. That was a big bear trap. Flush out move. It looked like the dollar had broken down from that support, and again, that's when I started to become bullish. I recognized that was a key support level, but was calling for a reversal in the dollar, and that's what we've got so far. And this was fuel, the fact that we broke down below, but intra-week. This is why when trading a weekly chart, you wait for a weekly close on that candlestick, and you didn't get a close below the support zone. So anybody that shorted the dollar or went bearish on the dollar on that breakdown intra-week had their clock cleaned on this reversal. So where we go now, we're a little stretched, as I said, in the near term, but so far so good. And the dollar still looks, it might have some more legs in it. And, I'm just getting my near-term direction on gold and the dollar and everything else. My conviction isn't nearly as strong as it was before, and that's why, as we're getting down to these target levels, I'm more concerned with starting to take some profits, take a step back, and regroup, wait for the next objective setup, and instead of trying to nail the bottom here and catch a reversal and a bounce. But again, we'll see what happens next week. Okay, moving on to the broad markets. Here's QQQ, the index that I look at them all, but this is the one I put a lot of weighting into and I'm really following. This is the leader, the NASDAQ 100. Last week I had pointed out these, at the time when they were potential divergences and then they were confirmed divergence. And, shame on me personally. I should have tightened up stops on my shorts or taken some profits. I didn't do that. I didn't think these would play out as much as they have. I've held on to nearly all my shorts, and I still think we're going back down lower. Even then, again, in hindsight, I would have stopped out here when we took out the top of these, maybe at least the top of that reaction high, and we built on those gains. But if you look at just the scope of the divergences, in other words, from this point to here, that move to me really satisfies the amount of the divergences, both on the Q, MDY, the mid caps, the small caps. So I think that there's a very good chance that that positive divergence has played out to the full extent is what I'm trying to say. Here's a gap back here, big gap. You can see it well defined, and that's so far where we're turning back down, or at least we stopped today. We've moved down off that level. This will have to be continued next week. Like I said, there's less than 2 hours left in the trading day, 3-day weekend, so I don't expect a lot of fireworks before the close, but it'll have to be continued. Now, what I was talking about, the longer divergences, you can't even see it here on the 60-minute chart. This wedge comes off, goes to the left of the screen, but these were much longer standing multi-month divergences, and they played out for this move. And so you have I always say the larger the scope of a pattern, the bigger the expected move. So this was a relatively small divergence on the 60-minute chart that only spanned a few weeks here, a couple weeks, about 3 weeks. And again, I think that probably satisfied that move. Bigger picture, going back to the daily chart. This is a QQQ daily chart. Here's the yellow downtrend line. This chart's a little bit busy, but you have that yellow downtrend line. You can see a couple reactions up here, reaction there. We had some reactions here, and now we're challenging the downtrend line on the Qs. We had that bullish divergence in place. Almost bullish divergence. We almost made an equal low right there. Close enough, but that divergence I'm not crazy about. I don't like these flatlining MACDs that are just crossing and trading together. I like to see a differential, or spacing, I should say, between the troughs in the MACD like you have here. In other words, you have a low, you go up, you make another low. That's what I look for in divergences. Just like you see here. So you have that white space in between. We never really had that there, so I'm not really crazy about that daily divergence, but I did want to point it out. And that's the same divergence I just pointed out on the 60-minute chart. Let's look at the SPY, S&P. We can look here, and we have potential negative divergence, potential because the MACD is still pointing up. So what I'm looking for here, if the SPY manages to take out that high from, you can see this candlestick, the wick back here on April 20th. We're not far from it. If we get up equal or above that level, and the RSI and the MACD are still making lower highs, then you have the potential for a negative divergence, especially if they turn back down and cross back down. Then that'll be confirmed. So we're looking at potential negative divergence on the SPY daily chart, and these are your trends right here, trend definers. When you see negative divergence on the daily time frame, that's where you have a heads up to position for a swing trade that can last weeks, possibly months. And that's, as a swing trader, this is what you want to see. And then again, I use the 60-minute charts, the intraday charts, drill down 60-minute, 15-minute, 30-minute charts to hone in and confirm the entries and exit points. And along with what I see on the daily chart as far as resistance levels go and support levels. There's the ascending broadening wedge pattern. We're still within that. We had a little brief fake down here one day where we dropped down and closed just below that pattern. You can see that doji type candlestick there, and shot right back up in there. But as with the Qs, we're at downtrend line resistance, and on the SPY, this is the most significant downtrend line. You have 1, 2, 3, 4, nearly 5 there, 6, now 7. Well, I can't call this a reaction yet because we're on the line. A reaction would be if we pull back, a meaningful pullback off that level. And if so, that would only further validate this downtrend line. So whether you're bullish or bearish, one thing's for certain, the SPY remains in a downtrend, because the simple definition of a downtrend line is a security making a series of lower highs, which is what you have here with a downtrend, and lower lows, which is what you have here. Each of these three reaction lows are lower than these two are lower than that one. So there's your downtrend, but it is in jeopardy, and we're not far off the highs. I know a lot of people are clamoring for new highs, and that may be the case. But there's quite a bit of resistance besides that downtrend line. I can put a line here. It captures that reaction high and this reaction high. Quite a few right here. You have these other reaction highs. And again, the SPY is really within earshot of new highs, less than 2%. While the Qs, the leading index, are down, we're looking at about 5% just to get back to the highs. And you look at the small caps, and they've been entrenched in a vicious bear market. and they'd have to rise all the way just to get back to their previous highs. You're talking over 14, nearly 15% or so to get back to the highs. And like everything else, they're at potential downtrend line resistance. We need to see another reaction. We have this yellow downtrend line off the highs. There's a reaction, and it depends what happens here today. So, and if we punch through there, just like I had a downtrend line here, then this will have to be redrawn. That won't be valid. And but we have, like I said, quite a bit of work to do. This is a busy chart, but there's also the negative divergence that we had here at that high. And if the IWM happens to take out this previous reaction high, here, maybe I can show it to you better on another board. Let's see if I can find a clean board. Okay, flip to a clean board and I drew these lines. And so let's just say that we do move up a little bit right here. Come up, take out that previous reaction high, which on face value might seem bullish, and it would be on face value again. But if we reverse from that point, you have prices now making a higher high from this point to this point up here, wherever that might be. And as long as the RSI doesn't take out this previous high back here, and the MACD rolls over, then you have the confirmed negative divergence, and that is a very real possibility. So this would be, I'd almost favor it at this point, just looking at where we are, how the markets are acting lately. There's a bullish bid underneath the markets right now, and I almost favor a little more upside next week, which would probably terminate early next week. So maybe Tuesday when we open for trading, Tuesday, possibly Wednesday, and by the end of the week, see the markets roll back over, confirming the divergence here on IWM and some of the other major U.S. stock markets. Okay, we'll wrap it up with USO. Take a look at oil. Oil's dancing on. Here's that bearish rising wedge pattern that was pointed out on crude oil spot prices as well as USO, the ETF here. You have a pretty well-defined downtrend line. You can see this morning we caught right around the bottom of that downtrend line, bounced, a very weak bounce. Prices are flat right now as I do this video. And just based on eyeballing this wedge, where we are, where prices are in proximity to the apex of the wedge, we're in the sweet spot. This is where you expect a breakdown. Now, with now about an hour and a half left to the close, we might not get that today. Even if we did, end of day breakouts or breakdowns, if it happens right before the bell, doesn't mean too much. You want to see follow through. So this will have to continue next week. We'll just have to keep an eye on this. And my guess is on Tuesday when the markets open, we'll probably have gap down below that level. That's just my best guess right now. But either way, this was detailed recently on the front page. All right, I think I'll wrap it up here. If there are any questions or if I come across anything else that I didn't cover here, I'll put it up in static post either later today or over the weekend. So wishing everybody a happy and healthy weekend. For those of you in the U.S., enjoy your 3-day weekend, and I'll see you guys in the trading room.